Hi guys, got some price action trading to talk you through this morning, and I would love it if this was the video that was the catalyst to turning your trading around. I'd love it if this was the seed, if we could sow some seeds for you today to show you just how profitable you can make your own trading. So let me know what you think about this video. Let me know about the ideas that I put forward in this video. We're going to look at trading in a slightly different way to the way that you perhaps normally look at your charts. So let's have a look at this one that we've got in front of us here. And you'll see that it's a line chart. And so let me just ask you a question. Have you, just by looking at the line chart, have you any idea what time frame this particular chart is on? Have you any idea? Is it a daily chart, a weekly chart, a monthly chart, or a 2-minute chart, 1-minute chart? What time frame is it? And what market is it? Have you any idea? Because for me, this could be any chart in the world. If you take away these numbers on the right-hand side here, this could be any chart in the world. It could be any time frame and any market. And the fact is that when you understand how to really assess price action, and when you understand how to trade price action and really read price charts, then you can trade any chart in exactly the same way. Okay, so I'm looking for context and I'm looking for content, and I mainly use these line charts for context, so to provide good context for trades. And then I'll look at the line charts, I'll say okay, that's a good context, and then I'll perhaps look at the candlestick charts to get confirmation of the content within the price action and decide whether it fits the type of trade that I'm looking to take. So let's get started. So looking at this particular chart then, this is the 1-minute chart on the DAX. So it is a 1-minute chart. So super fast. Every one of these lines here is 1 minute, represents 1 minute of price action. So it's a super fast chart. And does it operate any differently from any other chart? Well, the answer is no, it doesn't. It operates in exactly the same way. So if people tell you you can't trade anything under a 15-minute chart, then they're wrong. You can actually trade any time frame as long as you understand price action and how it works. So starting at the beginning of the chart here, we've got, obviously based on the context of this chart, and we wouldn't know this at the time, but we've got a high here and we'd know that we've got a low here. Market went up, came down, so we've got high, low, lower high, lower low. Okay. So based on that, the market is in a downtrend. Looking at these highs and these lows, we've got, if you really look hard, you can see that we've got a micro double bottom there, and then the market started rising. We've got high, low, lower high, lower low. So traders are starting to think, is the market going down? You've got another high here, which is a lower high, and then we get a lower low. So the market's going down, and then the market opens. This is 8 o'clock in the morning. The market opens. You've got a low, market spikes up, pulls back very, very slightly, and then moves up to the top. And where does it move up to? Well, it moves up to the same level as this particular high here. So when you then, at the top, you get a high, pull back, lower high on a small time frame, small time scale. As soon as the market crosses below this particular low here, then you've got a potential trade short. And market hesitated slightly here, can't really see it very well, but there's a couple of pullbacks in here, and then the market decided to really zoom down. So market's definitely in a downtrend. We've got the round number here, 13,300, to bear in mind, and the market's crashed through that particular level. This often happens in markets, round numbers. It's very rare for the price to stop exactly on a round number and then bounce off. Very often it goes below it and then starts crawling back up. And this is what it appears to be doing at the moment. So at the bottom here, what we've got is we've got the start of a pattern, and so we're looking at touches here for these lines, and we can establish these lines based on 4 touches. Okay, so there's the first on that side and the second on the bottom of this particular pattern. There's the first touch on the top and the second touch here. So you can actually draw these lines in at this particular stage. And so what have we got within this pattern here? Well, we've got a low, high, higher low, higher high. So it's confirmed now that the market is no longer in a downtrend as it crossed this particular level here. Market's no longer in a downtrend. It may be in a trading range, maybe in an uptrend at this, bearing in mind we're at this stage here. The market then makes a high, pulls back, lower high. You've got a double top in there. Just going back to this one, you've got high, low, higher high, higher low, lower high, lower low, lower high, lower low. So within there you have a mini head and shoulders pattern, and within here you've got a mini double top pattern. So you've got left shoulder, head, right shoulder, head and shoulders, top, and the market came down. You've got a low, high, higher low, higher high. On a micro time scale, the trend's changed and the market's starting to go up. And then the market pulls back to test this particular low, fails and moves higher. That's also a double bottom. As already discussed, you've got a micro double top in here and the market comes down. Where does it come down to? Well, it comes down to just above the pattern line here. So, the question is this pattern here a broadening wedge? Well, it could be a broadening wedge. It could be a broadening wedge, but it also could be another type of pattern. And in actual fact, it was a 3 rising valleys pattern. So valley 1, valley 2, valley 3. So valley 1 comes down, makes a high, higher low, higher high, higher low, higher high. So people who were at this particular stage, as we're here, looking to take the bounce south or down from the pattern high, then trade it down here or here somewhere, then they were disappointed because they got the wrong pattern. This was a 3 rising valleys pattern, and with this particular pattern you're looking to enter the trade as the market goes above the high of the second peak in the pattern, and the target for this particular trade is the height of the pattern, as you can see here. So the lowest low in the pattern to the entry level, that's your target, and you can see in this case we reached target quite comfortably, and we reached it just above the pattern line before we got a reaction to this broadening pattern or this broadening channel here, and the market started going down. Okay, so what did we get at the top of before the market started going down? Well, we got a micro double top, we got a high, low, lower high, and the market crossed the boundary of the low to make a lower low, and the market started going downwards. So as we're at this stage here, you can see that the market's hit the 90 moving average and it's just started to bounce. So what do you reckon is going to happen? Do you reckon it's going to go back up here, or is it going to go down to the bottom of the broadening channel here? What do you think is going to happen? There were clues left by the market, and what you can see here is that we actually had a divergence. Okay, so if you know your indicators, this is the stochastic indicator, and you can see that the market made a high, pretty much higher highs all the way through, confirmed by stochastic, as the price is moving higher, making 1, 2, 3, 4 peaks, 1, 2, 3, 4 peaks on stochastic, and then market dips slightly, makes a higher high from a price perspective and makes a lower high from a stochastic perspective. That's a divergence on that particular indicator, and temporarily it indicates that there's going to be lower prices. And so when you've also got a double micro double top in here, then you've got a good trade, expecting it to go down to the pattern low. And as the market's moving down, what's it doing? Well, it's making lower lows and lower highs. Lower low, lower high, lower low, lower high. There you go. And the market, that's how the market trends down. So on high time scales, on high time frames, on low time scales, low time frames, you get almost exactly the same type of price action. It's so important to understand how trends work and how markets move. When you're getting higher highs and higher lows, then the market's going up. When you're getting lower lows and lower highs, then the market's going down. I think we make trading far too complicated sometimes, and these line charts definitely help.
Here's another chart for us, and this is from Wednesday the 7th of February. And what's this chart? Is it a 30-minute chart, a 5-minute chart? It's the 1-minute chart again. There is no difference between these charts. There are no differences other than the price index on the right hand side. There's no difference in the way they operate, and there are no differences in the way that the price action develops. So let's just run through this chart. We've got a high, a low, lower high, lower low. The market's moving down, it's in a downtrend. When the market goes above this blue 8 EMA, the traders, the institutions, they're selling. They're selling when it goes above the 8 EMA. Nothing in it for me because there's no chart pattern here. And then the market comes down. So the market makes a low, mini revival, and then a lower low. But this low is very close to the previous low, and traders will be on the lookout for possible head and shoulders patterns at this point in time. Left shoulder, head. What do we get? We get a right shoulder. Head and shoulders pattern. Also, you'll notice that we've got on here, we've got some sloping lines. This is actually, I'll show you in a minute, but this is actually the lower side of a bear trend channel. So the lower level of that trend channel, and this is the middle here, this sloping line here. So the market's come down to a sloping support level. It's broken through and it's struggling at this stage to go any lower. And so what do we get? We get a 1, 2, 3, 3 rising valleys chart pattern. And so the market makes a high, a higher low, higher high, higher low, breaks that second peak and goes up. So that was a good trading opportunity there. And obviously you can see sloping lines. It's in a bear trend channel. We're going long, but we're also going long from the low of that channel, and there's plenty of room for a trade. There's also, you can see the market was reacting to these highs here as it starts to go down. So the market goes down, makes a low, lower high, lower low. However, we're still at the bottom of this channel, and it's reacted 1, 2, 3, 4, 5 times here. The market goes up, comes back down, and it's in a trading range at this point in time. It's made a high, a higher low, almost identical high at this stage. Let's have a look. Just a slightly higher high here, then the market's come down. It's come down and it's reached almost an identical low here, and it's bounced. So let's just have a look at the candlesticks within this pattern here. So I use line charts and sloping and horizontal lines for the context, and the candlesticks are the content. So let's have a look particularly at what happens here within this 3 rising valleys pattern. Let's have a look at the candlesticks here. So what we've got is market's coming down. So the market's coming down here, and this is the first low. Okay, So let's just read what's going on here. We've got an up move here and a down move here. We've got an up move here and a down move here. What's stronger, these two bars here, these bull bars, or these four bear bars? Obviously, the market's making lower lows as well. So when the market turns at the bottom here, then traders are going to be looking to sell. So they sell they wait for this bull bar and then they sell. And unfortunately for them, they actually ended the bar with a higher low. Market then goes up, makes a slightly higher high, comes down, higher low. And so let's just look through these. What's stronger, this bull bar here or this bear bar here? Well, they're almost identical, aren't they? So when the market comes down, you've got people buying and you've got this bar here. Now, which is stronger, this bar or this bear bar? This bear bar or this bull bar? Well, the bull bar is an engulfing candlestick. It engulfs the whole of the body of the bear bar. So you'd have to say that that's stronger. So when the market then sells off, people looking for another lower low, they don't get it. And then there's a slight spike at the bottom here. This is a trap for the bears. People are selling there and they're trapped because the majority of people looking at this can see that the bulls are getting stronger. Higher highs, higher lows. This bar's strong. This bar's weaker than this bar. And you've got a break of the highs here. This is our entry for the three rising valleys pattern, and the market goes higher. So one valley, two valleys, three valleys, market goes higher. Let's have a look at this on a bigger time scale. This is still the 1 minute chart. So we're still reading 1 minute price action. However, the chart's really condensed here. So it gives us a better perspective as to what's going on. And you can see that the market's going down. Obviously, it's making a high, low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Market's in a bear trend channel. You can draw the channel by, first of all, drawing the trend line across these two peaks here, and then a parallel line which you can draw using this spike here. Market comes down and it's reacting to the lows, and the three rising valleys pattern was in this tiny little bit here, and then the market starts going up. And what have you got? You've got a low, high, higher low, identical high, must be a slightly lower low but very similar level. So you've got 1, 2, 3 valleys again, and the market's just crossing the top of this second peak. It's not a perfect three rising valleys pattern, but it's close, and we'll see whether it was close enough. Interestingly, you can see within here some very, very important price action, because this was when the market had the opportunity to fail in rising higher and go down again, and it didn't. I'll have a look at that in a minute. And the market did complete the trade to the top of the trend channel, and the three rising valleys pattern completed quite nicely there. And this is the 12,500 round number level, so the market reacted to that particular level. Let's have a look at this move in a bit more detail then, so you can see it in more detail here. We've got move down. Here's our three rising valleys pattern, the first one we talked about on this chart at the bottom here, and then we've got the bigger one. So you've got one valley, two valleys, three valleys, and this was the important piece of price action that I was talking about here. And so let's have a look. What is it? It's a flag. So it's a bull flag, and you can see that when just looking at this, when the market's going up and down, it's going up here, went above the red 20 EMA and got sold off very quickly down. The majority of the price action is taking place below the exponential moving averages, goes up above the exponential moving averages and sells off quickly again. And then we get to the bottom, and this is a higher low. It's a higher low, and that's a higher high. So the market here is making a decision: am I going down or am I going to go up? And the market goes up above the exponential, the 8 and the 20 exponential moving averages. It forms a flag pattern, so high, low, identical high, higher low, high, higher low. The higher lows are being pushed up, prices are being pushed up almost by these exponential moving averages, and when the price breaks these highs, then traders are going long, betting that the market's going to go up to the top of this particular trend channel. And so what actually happened was the market did go up, and it started consolidating at these levels here. There was a tiny trade, but good reward to risk trade within here as well. So we've got a high, higher low, higher high, and then a lower low and a lower high, and it's starting to make lower highs and lower lows in here, on a micro time scale, as you can see. And so you could draw your line across the bottoms here, and when the market goes below this line here, and it's been pushed down by the 8 exponential moving average, as you can see, there's a squeeze going on there between the 20 and the 8 exponential moving average, and the bears temporarily took control. There's a double top in there as well, and there's a head and shoulders top in there if you look carefully. Left shoulder, head, right shoulder. Double top is, you could say, this one top, lower top, higher top, lower top, whichever way you want to look at it. Higher top, lower top, and the market comes down, putting your stop above this very, very small lower high here. Market comes down, makes a double bottom, and then starts going up. So you've got a high, higher low, and a micro double bottom in here. Market pulls back, goes back up, and then makes a higher low, and as soon as the market crosses that level, it also crosses the 90 exponential moving average, where it spent a good amount of time here, spent more time above here, this 90 moving average, than it spent time down here below it, and you've got a low, higher low here, and the market's going up. So the market goes up, pulls back, people bought that pullback as well, and market went to the 12,500 level. There are so many trades, guys, in these charts. There are so many. It really just depends on how you're looking at your charts. These line charts really do reveal the whole of the story. The institutions, they use these line charts, and so should you. And you do need to keep an eye on the content as well. You need to keep an eye on the candlestick charts. There's a lot of stuff to trading. You need to understand chart patterns. You need to understand your candlestick patterns. So let's have a look in particular at this price action here and this price action here to see what we can read into it from a candlestick perspective. So here we go. This is the flag that we got. This is your flag. I'll just move that line away so you can see what's going on. And so what's stronger here? This move here or this move here back up? Well, it's got bear bars, but there's no follow through on them. There are bull bars intertwined with the bear bars, and whilst the market's going down, that's not a strong move. Here you've got 3 bullish candlesticks on the trot. You've got a morning star pattern at the bottom of the swing here. So the market goes up, and what's stronger, this bull bar here or these 3 bear bars? The bull bar's a lot stronger, isn't it? So you've got buying at the bottom here, buying at the exponential moving averages, and the market goes up. Market comes down, and what's stronger? This little move here with spikes or this big bull bar? Obviously it's the bull bar. And then the market goes up, so it gets bought off the exponential moving averages. Market goes up, 2 bull bars, and then a final bear bar. And what's stronger, these 2 bull bars or this bear bar? got to be the bull bars, and you've got two spikes below, and this one here, this final candlestick before the market goes up, is a pin bar, and that's a 2-bar reversal as well. Bear bar, bull bar going back up, and traders bought the high of this candlestick, this pin bar candlestick here, and the market broke out higher. And so let's have a look at what's going on at the top here. So this is you can see it's a double top pattern, high, lower high, but there's consolidation in here as well. The market's going up, but it's going sideways here. And so let's see if there were any clues with regard to the move down off this double top. Well, you can see this is a strong bull bar, so when the market comes back down, the bulls bought again. They bought strongly, but there's resistance at these highs here, and the bears are starting to get a footing. It's a fairly good bear bar followed by a bull bar, which actually closed slightly lower than this particular bull bar, and so you got a bear bar which closes lower than this bear bar. The market's starting to go down, isn't it? And it then starts to spend time below the 8 exponential moving average, between the 8 and the 20. The price has been squeezed between those 2 exponential moving averages, and finally you've got your pin bars here. You've got a bull bar which is tiny, and it's got a pin or some rejection, a spike on the end of it, and then a bear bar with a big spike on the end of that. That's a perfect pin bar, short, and stop on this one. You don't need to put it above the high because you can put it above the open of this bear bar, the high of this bull bar, because you've used the line charts to do your analysis and you know that the double top's in play, and the market comes down and gives you a good 2-to-1, 3-to-1 risk to reward trade there. Another chart for you here. This is the 5-minute time frame, and same sort of rules applying here. We've got a head and shoulders top here. We've got a left shoulder, head, right shoulder. Market starts coming down. Within this right shoulder here, just at this stage here, you can perhaps see that the prices are starting to reject below the exponential moving averages. Very condensed price action on this particular chart so that you get perspective on what we're going to see next. However, there'll be a reversal pattern within this price action here, and it would enable traders who are looking at this type of thing to go short and take the trade down. You've got a small flag formation here, and with flags, the flagpole is normally duplicated by the following move. Flags are trend continuation moves, and that move there equals that move there, and then traders started buying at the bottom. You can see again on this particular chart we've got context in the form of a bear trend channel. So here's one peak, second peak, enables us to draw the line, put a parallel line along the lows, and you've got your bear trend channel and a value line in the middle, and you can see that price is going up and down around the value line. Institutions trade around value. They buy below it, they sell above it, and these are the fundamentals of supply and demand, and you can see them playing out in the markets continuously, and you can see them better using the context from these line charts than you can from the candlestick charts. So we've got our flag formation, market comes down, makes a pullback and nearly reaches the middle of the channel before heading back down. You've got a head and shoulders pattern in there as well. You've got if you can see it, the left shoulder, head, right shoulder, market comes down, makes a double bottom at the bottom here. You've got the lower low, higher low, double bottom, and it's right at the bottom of a very broad trend channel, so traders took the trade higher. This was all happening yesterday, and then it reached the high of this trend channel and came back down again, of course. So coming to the charts this morning, you see the market's still in this overall bear trend channel. It's made a slight recovery back to the middle of the trend channel, and you've had a high, lower high, so double top, and the market came down. The market then came up again, peaked, and you can see it's starting to reject quickly from above the middle of this channel. Chances are the market's going to come down to the low of this trend channel somewhere, possibly stop at these lows here, and then it'll decide what it wants to do next, and we'll trade according to what we see developing in the charts. So have a look in a bit more detail. You can see there's the middle of the trend channel. This is the 1 minute chart now, and this is 8 o'clock here. So prior to 8 o'clock, market's still doing what we'd expect it to do. It's making high, low, lower high, lower low. You've got a double top formation in there. Then just approaching the open, market makes a high. You've got a micro double top in this high, and it's above the middle of this trend channel, and it's above these highs here, these pre-market highs, and so it's a good shorting opportunity for traders who are looking to get in just before the open. Market comes down and plunges down on the open. And so here's the 12,500 level here. Market came down, took out traders' protective stops down here before making a recovery. And very often on these markets, indices, forex markets, the pre-market range, which would start as a high here and a low here, the market works within that range before making a convincing break out of it. So it failed to move away from the highs of the range here, and it failed to make a move down from the lows of the range here as well. The market was bought up. So what have we got at the top here? We've got 3 falling peaks at the top here, and so you've got the high, low, lower high, higher low, lower high. The market's being condensed in this price action, and then it comes down. It comes down to the just above the round number level, 12,500. It comes down to these lows here, and it gets bought up. So you've got low, a lower high, higher low, higher high, higher low. Traders are looking to go long. You've got 1, 2, 3 valleys, and just above that peak there, the market soared upwards. It broke out upwards. At the top here, you've got a failure to go any higher. You've got the highs here, highs here, highs here, and highs here, and the market made a double top. So you've got the higher high, lower high, very small lower high, but the trade short below there was a good probability, and the market came down, and it's starting to make lower highs and lower lows. So high, low, lower high. We'll see what happens next. Let's have a look at these two, this pattern here and this pattern here in a bit more detail, see what was occurring via the candlestick charts. So you can see here, that's the first pattern and that's the second pattern there. So what have we got? We've got a big bear move down, lots of consecutive bear bars followed by a bull move up. What's stronger, that or that? Well, obviously people are going to be looking to go short because that's more powerful than, although that's powerful, this is more powerful. It's got more bars in it, and it's got the strongest bar on the chart as well, which was the 8 o'clock bar. So having a look at this, we've got a bear move down, a bull move up, weaker than the bear bar. We've got a bear move down, weaker than the bull bar. Price is being condensed, so it was worth traders who were thinking the market might go up, it was worth buying the close of this particular bar. They did, and it failed, and that's an indecision bar. It's a bar that you often see before the market decides, well, yep, I'm going in one direction or the other. You often get that type of bar. There's a spike on the top, there's a spike on the bottom. It's a doji. Sometimes they turn out to be long-legged dojis, but you've got another one here as well. That's a similar sort of bar. It's a range bar. And as soon as the market went below the lows here, everybody agreed the prices were going down. The bears had won this particular battle temporarily. Stop above the close of the bull bar here, an entry below these lows, and you get a good 2-to-1 out of it. So the market comes down, and what's stronger, this move up or this move down? Obviously this move up's got 1, 2, 3, 4 consecutive bull bars in it, and so when price comes down to a respectable low, a decent low, then traders are going to be looking to buy. And this is also the 12,500 level, and traders are buying, so it goes through the level and goes up. Comes back down. What's stronger, this bar here or these two bars here? Traders are going to buy these lows, and they did, and the market started going up. You've got 1, 2, 3, 4, 5, 6 little spikes at the bottom here. These are rejection spikes, and so as soon as the market goes above these highs here, traders are going long temporarily. And you've also got another one of those indecision bars here. You can see it here. So as soon as the market goes above these highs, the market's going up. And it goes up. You've got an evening star pattern at the top here. Another one of those indecision bars, and then the market's starting to come down again. So all of this price action's readable, guys. You just need to know what you're looking for. You need to understand your candlestick patterns, and you need to understand the line charts, how trends work. This is how the morning developed. So high, low, this is in a range at the moment. Lower high, higher low, higher high, lower low, and then it starts trending downwards. Lower high, lower low, lower high, lower low. Double top in there. First high, lower high, market comes down. Entry below the low in the middle of the double top. Stop above the second lower high. Market comes down. There was enough in that to give you your 2-to-1 reward to risk trade at least. Market's making a slight revival, but look, every time the market goes above these EMAs, here, 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 it gets sold off quickly, and the market comes down quickly. Slight bounce gives you your high, lower high, double top, and the market comes down. It's not rocket science, it is trading, it isn't simple, but if you've got the right tools at your disposal, then you can be successful.
Well, I hope that you found that useful, guys, and I'll be back with more of this type of price action analysis in the next video. Thanks ever so much for joining me. My name's Anthony Bidsall. Do have a look at our trading courses at Excellence Assured. I'm all for simplifying trading, and our trading courses are comprehensive and explained in hopefully a very simple manner for you, so that you can understand how to trade and find the best trading system, best type of trading to suit you and to suit your personality. Thanks ever so much for joining me.